Welcome to the Cash Flow Model training. In this video, we will cover the basics of the cash flow model and how to update it correctly. The cash flow model that Entrepreneur Org provides is a basic cash flow model that can be used to forecast your cash flow using the inputs of your business. Please note that it's critical that you identify all your costs and have an accurate sales forecast prior to starting the cash flow model. All inputs are based on a monthly schedule, so it's equally important that the timing of your costs and sales are accurate by month. Once you download and open your cash flow model, you will see two tabs. Let's look at the Instructions tab first. The cells in the cash flow model are highlighted in different colors to make it easier for the user to identify which cells are used for updates. A black cell is blank and not used. A blue cell contains an automatic formula and cannot be updated. The cell is locked in the spreadsheet and you will not be able to click on it. The yellow cells are where the user will be inputting their data. To start the process, the user will update the data in the yellow cells and the formulas will automatically calculate the cash positions. The rows within the cash flow model are pretty much self-explanatory, but if you have a question, you can always refer to the detailed explanation in the Instructions tab. If we take a quick look at the cash flow model, you can see what we mentioned before. You have the yellow cells, where you'll be updating all your information, the blue cells that contain the formulas, no information is needed there on the part of the user, and then the black cells, which are just blank cells that you will not use at all. To start updating the cash flow model, we start in cell B3. B3 is what we would call the startup. In this cell, we want to go ahead and put in the amount of money that the entrepreneur is going to have in the bank at the time of the startup for paying his bills. For this scenario, let's put in $25,000. Once we enter that, we see that all the cells in the blue automatically update. Now remember, these are the calculations, so as we go along, these numbers are going to change. We work our way down, and the first thing we look at is cash receipts. So this is going to be money coming into the business on a monthly basis. So for this scenario, we're going to do a couple things. One, we already entered that the customer started with $25,000 in the bank. Two, we're going to assume that the business sells $25,000 a month and it's going to be even sales. So every single month they will have $25,000 in sales. We will also say that the terms for the customers to pay is net 60 days. So 2 months after they receive an invoice is when they will pay the invoice. We're going to say that this is a product that has a 40% margin, which means that if we're selling for $25,000, our cost for the equipment is $15,000. The terms with the vendor are going to be cash on delivery. So when you normally start out a business, you're not going to get terms with vendors. You're going to most likely have to pay up front, and this is what this situation is going to show. And then we'll also say that the lead time from the vendor is 1 day. So as soon as we pay them the money for the equipment, we receive it in 1 day. So now we can start updating the spreadsheet. And if we look under the cash receipts portion, we're going to say these are the collections from the invoices that we're going to have. Simple way to think about this is if we sell $25,000 per month, we're going to invoice $25,000 per month, and then every month our customers are going to pay us $25,000. Here's where you need to be careful. Many times a first-time entrepreneur will put $25,000 per month every month, not taking in consideration what the terms are from the customer. So if the customer pays net 60, we know that the first 2 months there will be no payments, but starting on the 3rd month, we will receive $25,000 per month, and that will occur every month for the rest of the year. So we'll go ahead and enter that, starting in the 3rd month, ending in the last month of the year. The next row is for other. In this row we have other receipts that we might anticipate coming in for either loans or additional investments that the entrepreneur might make into the company. For this scenario, at this point in time, we're going to leave this blank and we'll work our way down to cash paid out. In the cash paid out section, this is all the invoices, any expenses, any costs that we have on a monthly basis that we plan to pay out of the company. So row 12 is purchases for product. This is going to be used for the equipment that we're going to buy and then sell to the customer. Remember, we said the customer is going to buy $25,000 worth of equipment each month at a 40% margin. Our cost for the equipment is $15,000. So what we'll do is we'll put $15,000 into month one, and it's going to be a monthly cost because every month we're selling $25,000. And we start to see a problem as we put this in because we know that we are paying out $15,000 per month, but since the customer is only paying on net 60 terms, the first 2 months we're not going to have any income and we're not going to start seeing our payments until the third month through the end of the year. The next column is for payroll and taxes. Starting new business for the scenario, we're going to say that we don't have any employees and we're not currently paying ourselves, so we'll leave this open. Next column would be advertising. This would be your advertising expenses and marketing. We'll go ahead and put $300 per month. Delivery of the equipment, we'll put $300 per month. For rent, we'll say $1,500 per month. All these are the same reoccurring costs. Utilities, phone, electric, we'll say $300 per month. Insurance, we'll enter $300 per month. And then in the last this last row here, last couple rows, we have other. You could use this bucket for anything that's not captured in above. We're going to leave this open for now. Then we have loan repayment. Currently, we'll leave this blank, but if you had a line of credit or if you had some type of loan information that you had to do repayment, this is where you would put it. And then our last row is for capital expenses. When we say capital expenses is if they're going to buy some equipment or they're going to make some capital expenditures, this is where you're going to capture when it happens in the first year of your business. And for our example, we're going to leave this blank as well. So now that we entered all the information in the cash flow model, we can go back and take a look and identify what kind of information that it's providing us. Starting at the top, we have the cash in the bank at the start of the month. We know that we started with $25,000, so that first month, we know we have $25,000 to start to pay our bills. We look at the cash receipts. We're not going to receive any payments from invoices. We don't have anything coming in from any loans or line of credit. So our total cash received for that month is $0, and then our total cash available for payments is still $25,000. When we move down to the line where it says our cash paid out, we know from our equipment purchases and then all of our monthly costs, our total for that month is $17,700, and then the balance of that, so the difference between what we paid out versus what we had on hand at the beginning of the month is $7,300. So that first month, after paying all of our bills, we have $7,300 left. That $7,300 at the end of the month gets moved up into the next month to be the beginning of the month balance for February. This is where we start to run into a little bit of trouble. We start out with $7,300 in the bank. We know that there's no money coming in, so we only have $7,300 to pay our bills. If we go down, we know that there are $17,700 worth of bills that are going to be due. And this is where we start to look at when we run into a negative cash flow, and this is the reason that the cash flow model is important. So in month 2, we're short $10,400. Even though we started with $25,000 in the bank, we have $25,000 per month in sales. Month 2, we're going to be short $10,400 that we won't be able to pay the bills. So before we go ahead and make any adjustments to the cash flow to correct that $10,400 deficiency, let's just take a look at the cash flow line a little bit to understand it. Okay, if we take a look at it, we know that month 2, we have a $10,400 negative cash flow. Month 3 is $3,100 negative cash flow. Then we start to see the cash flow problem disappear, and our cash flow position actually strengthens as we go throughout the year. The reason for this is because when we started, we didn't receive payment for the 2 months. That was where we had the major cash flow issue. And then once we started receiving payments every month, our cash position strengthened. So let's go back and see what we would need to do to adjust our cash flow model to make our business sustainable. If we go back to where we have our first problem, which is in month 2, we know that we're short by $10,400. Let's say that the business owner did his due diligence and he had a line of credit, and he had planned that in this month he would go ahead and get $10,400 from his credit line. Once we update that for the loan, we can see at the end of the month our balance is 0 and we're no longer cash flow negative. Now, an important thing to do is understand that if you do have a line of credit, you can go ahead and add the positive cash into your bank, but you also need to account for the loan repayment. So for this scenario, let's just say that the plan is to put $1,000 back into our payment line per month to account for what we're taking out of our cash flow for our credit line. So once we take a look and we updated our cash flow model, then we probably want to run a couple scenarios. So what would be the impact if the customer terms were net 60 and the customer paid net 90? To update our cash flow model, we would go back to the collections portion of our invoice, and we would know that the first 2 months that we didn't receive payment would be because it was net 60. And if they started paying in 90 days, we would go ahead and remove the $25,000 out of the third month and see what kind of impact we have. We can see this has a major impact in the business. Even though we put $10,400 into month 2 of the business, we can see that by losing one payment of 30 days early in the business, we have a negative cash flow, an additional negative cash flow of $18,700. So again, if we take a look at this scenario, we started out with $25,000 in the bank. When the customer was net 60, we had to put $10,400 more into the company in order to prevent it from going cash flow negative. When the customer takes an extra 30 days to pay early on in the business, we're short $18,700 more money. So let's go ahead and update our cash flow model for that. So the value in the cash flow model is when we first loaded our cash flow, we might have had the assumption that $25,000 to start the business, selling $25,000 per month, we wouldn't have any issues with net 60-day terms. Right away, we realized that we had to put $10,400 more into the business or have some type of credit line. When there was an issue and the customer moved from paying net 60 to actually paying net 90, it cost us another $18,700 into the business to keep it going. So that's an extra $21,100 more than what we planned from the start of the business, and that's only when we get to month 3 in our business. So this is a very simple scenario that we're going through, but the importance is that when you run your cash flow models, that you take a look at all the different scenarios so that you can understand how different things are going to impact your business and be ready for it. The key is, number 1, to have enough funding in advance to run your business correctly, but also to have emergency lines of credit or opportunities to go get different funding in case different things happen. As you go ahead and put your cash flow model together, you probably want to run through a bunch of different situations to see how they impact your cash. You want to look at the terms with your customer, how the terms with your vendor affect it, what happens if you have returns, disputes, a quality problem. Uneven sales is a major one. In this scenario, we're showing that we have $25,000 going out every month, and then after 3 months this customer is going to pay $25,000. But as you do your scenarios, try to stagger your sales and you'll see how critical it is to have a reserve set up for your cash flow. Think about how the late payments would impact your business. What about a non-payment if a customer went bankrupt or just absolutely refused to pay and you couldn't get collections from the customer? Then what you want to do is you want to go through your scenario and think of what happens if you're not getting the sales price that you want and you just blindly lower your sales price. So your cost for your equipment is going to be the same, but you're actually lowering your sales price. You will see the huge impact it has when you start to reduce your margin. Then the other one that you have to really look at is you have all your costs set up monthly and you know what's going to cost. What if you don't hit your sales forecast? Remember, 95% of entrepreneurs don't hit their sales forecast. Set your business up, run it through all the different scenarios so that you're prepared for anything that might happen. Once you go through all the scenarios, you will have a better understanding of how cash flow is impacted. For more information, you can download the cash flow charts that we created that go over a lot of different scenarios that we mentioned. These charts show the impact on cash flow based on the many scenarios that we mentioned above. Make sure you become an expert on the cash flow model, as this is the number one reason why businesses fail. You have to be prepared for the different scenarios and you have to make decisions based on how it impacts your cash flow. If you have any other questions, always feel free to contact us and we'll be happy to help you. Thank you for taking the cash flow model training.